Is there a correlation between the stock market and gross domestic product? Well, the stock market frequently serves as a mood gauge to understand the economic sentiment of the country, which has usually been seen fluctuating along with the ups and downs in the stock market. Although the stock market can positively and negatively influence GDP, people's spending ultimately drives GDP growth. We must first examine what propels economic growth to ascertain how the markets affect it. Well, spending and investment are the main drivers of the GDP of any economy. A percentage growth rate of GDP is frequently displayed from one period to the next. When equity markets are increasing, we're in a bull market. The stock market largely impacts consumer confidence and financial conditions affecting GDP. Bull markets, where stock prices are rising, are characterized by considerable optimism about the economy and the prospects of different stocks. In contrast, a bear market, which occurs when the stock market is down, results in dropping stock values and may be unfavorable to sentiment. Investors hurry to sell stocks during a bear market to protect their investments from losses. Typically, the losses result in decreased consumer expenditure, especially if there are worries about a recession. 2 consecutive quarters of negative or decreasing GDP growth are sometimes used to characterize a recession. One pays less attention to the impact of the stock market on GDP than to the effect of GDP on the stock market. Corporate earnings rise with an increase in GDP, which is positive for stocks. So in conclusion, the stock market can affect gross domestic product as a measure of economic sentiment. A healthy and expanding stock market is a sign that businesses are doing well and will keep doing so. This inspires confidence in customers, investors, and companies. When organizations increase hiring, unemployment lowers, and they also borrow money, which has several beneficial impacts. More spending happens with more money and people employed, strengthening the cycle and raising GDP. The opposite occurs when the stock market performs poorly. So what do you think? You can leave a message below and you can subscribe to our channel. You can also press the bell icon to get notifications for our other videos. I'm Rachel for Kalkine Media.